Hi, everyone. Hope everyone's staying safe and doing well. Welcome to Mario's Home News live happy hour show on Facebook every Thursday at 4 o'clock. Today, I have an interesting show for you. I took some time to do some research, and a lot of the information I'm going to talk to you about today parallels a lot, and it feels a lot like what we went through in 2008. If you remember that time, it was very difficult. I think it's a little more difficult now, but I'm going to talk about the differences. So today's show is called The Good, the Bad, and the Ugly. So I'm going to start with the ugly, work to the bad, and then give you all the good news at the end. So let me start with the ugly. First of all, this has been a very quick decline in our economy. In a matter of a few weeks, 25 to 30 million people are unemployed. 3 million people, as of yesterday, are already in mortgage forbearance. And one of the things I want to talk to you about is go back 3 weeks to the show that I did about 3 weeks ago about not making or stopping your payments on the mortgage until you talk to your lender or your servicer. Very important. There's a huge difference between forbearance and deferment. If you run into a situation where you need to skip payments, you need to get approval first from your mortgage lender or the servicer, and make sure that you opt for a mortgage deferment, because those payments that they'll let you miss for 3, 6, or 9 months, they will be added to the end of your mortgage. If you opt for a forbearance and they give you 3 or 6 months, on month 7 or month 4, you're going to owe all 3 to 6 months plus the current month. So you do not want to get into a forbearance situation. And right now there are 3 million people that are applying for these forbearances and or deferment. So if you need to apply for one because of hardship, make sure that you apply for a deferment. So the other thing that's ugly right now is there's a lot of fraud going on, and there's a lot of telemarketing calls going on. I mean, we're getting a lot of telemarketing calls asking for personal information so that we can get this or that. You need to be very careful and don't give anybody that you don't know the information over the phone. People today are very fearful with uncertainty, and you also, because of that, because of the uncertainty, and people are preoccupied with a lot of million things regarding their own individual situations. You got to be careful when you're out there driving and going to the supermarket or the pharmacy, because people are not paying attention like they normally are, because they're very they're thinking about other stuff. So that's it on the ugly part. And the biggest thing about the ugly is the steep decline in the economy. Fortunately, the government has started to implement programs to add liquidity to the economy to be able to keep it sustained enough until we can all go back to work. So what are the bad signs? The bad is that in 2008, one of the things that happened were that the lenders, especially the lenders that dealt with challenged credit, which were called the B and C lenders, and also the lenders that offered products like no income, no asset, where you just listed whatever you wanted on the application, those went out of business from one day to the next. The parallel between that and today is that today, just a few weeks ago, what are called the non-QM lenders, they went into a complete stop. So that's kind of a parallel between 2008 and today, 2020. So that's not a good sign. Back in the day, one of the things that happened was that the lenders that stayed in business and the banks, they started to increase the credit score minimums for different type of loans, and they also started to increase the amount of down payment that was required to buy a house. and they also started adding a bunch of guidelines. That happened in 2008, and it's been happening over the last month now in 2020. So until the economy gets back on its footing, you're going to see it a little more difficult to secure mortgage loans in the near future. One of the things that also went away immediately, and it's starting to happen now, back in 2008, second mortgage lines of credit were discontinued. And those that had a second mortgage line of credit were frozen. So if you currently have a second mortgage that has available funds and you think you're going to need some of those funds in the near future, I would take the money now, because there's a real good possibility that those will be frozen again. And right now, they've already stopped taking applications for lines of credit in most situations for second mortgages. So keep that in mind. If you need the funds and you have a second mortgage, now's the time to take the funds out. There's sellers on the real estate side. There are sellers that are canceling listings, and in some cases, the prices are going down. It's not all that bad, because as sellers stop or cancel listings, it's going to reduce the inventory in the market, which will sustain the prices for everybody else. So even though that's a bad thing on one side, it's a good thing on the other side. There will be foreclosures that will occur, and there will be short sales that will occur as time comes up in the next few months. So if you're an investor, or you've wanted to get into becoming a investor in real estate and you have some cash available, coming down the road, there's going to be some opportunities to buy for cash and convert those into a rental property. So keep your eyes out on that. If you need help with that, let me know. So what is the good that is currently happening that will occur? And what is the good that has kind of like a parallel back to 2008? So real estate prices, again, will stabilize as the inventory reduces in the marketplace for homes that are currently for sale. The other thing is that we've demonstrated as a population that we're very resilient, and we will survive this. It's going to be a little difficult for many people. It's going to be tough, but you got to stay focused and understand that this too shall pass. The economy will come back. It's going to take some time, but it will come back, and we need to maintain a positive outlook. The unemployed will find new jobs, and they will reinvent themselves. That's part of the resilience that we have. The lending guidelines will begin to ease as the number of forbearance and unemployment begin to decrease. We're already seeing some easing of the guidelines. Now, one of the things that concerns me is that last week, Chase Bank changed big guidelines. They now require a 700 credit score, and they also require a 20% down. So what happens when a large institution like Chase does that? Sometimes the other national lenders, the smaller players, they may follow suit with some of those guidelines temporarily, which will make it difficult to borrow money if you don't have that 700 plus credit score and the 20% down and you're in the market to buy a house. The other thing in regards to this is that brokers like us are more flexible and have more access to different funds than the banks might do. The banks will be more rigid in the short term with their lending guidelines. Brokers have a menu of options that we can shop around for, because there still be wholesale lenders out there that will not be as strict as what I just mentioned with Chase and they're 700 plus with 20% down. So we will still have the availability, and that's where a broker business comes in with the options and the menu of a more diversified portfolio to be able to get you into that home. So what was one of the big things in 2008 that was a huge lifeline to many in the community? So in 2008, believe it or not, retired parents became a main lifeline to their children, middle-aged children, 25 to 45. And how did they become the lifeline to those children and their families? So what happened was that they started to use the reverse mortgage and use the equity in their home in order to help their children, especially those that may have lost their job. Maybe a two-income family went down to one income and things started to get real tight. And while the one of the members that lost their job was looking for a job, the parents actually went out, did a reverse mortgage. I remember we did quite a few of them back in the day from 2008 to 2010. I think, I was talking to Claudia yesterday about this. We were averaging between 20 and 25 reverse mortgage closings a month. And the majority of them, when we would ask, what's your objective for doing this? They would say, we're helping our kids. We're helping our grandkids. They were helping to pay the mortgage. They were helping while they were unemployed. They were helping to pay for the grandchildren's private school education, or wherever the grandchildren were going to school or daycare, whatever it was. The grandparents came in to this and they changed a little bit of their life to help the family. We're starting to see that again now because a lot of the customers we've been working with in the last 2 or 3 weeks are actually looking to do a reverse mortgage in order to anticipate having to help their children. One of the big things about a reverse mortgage that is very rarely talked about is the return interest rate that the senior gets on their equity of their home. So let's say for simple numbers, okay, the senior qualifies and they're going to get $150,000, okay, and they need $30,000 to help their children. Well, the other $120,000 can be kept in what is called a line of credit, which they can access within 7 to 10 days, depending on the additional amount that they need. That money, while it's sitting in that line of credit feature, today is earning between 4 to 5% in their favor. So it's like having a savings account that actually grows at 4 to 5% interest. The banks right now are paying close to zero on their savings account. They can literally, if they did a reverse and they're getting this 4 to 5%, they can take money out of their savings account and put it into the reverse mortgage line of credit. And those funds will also gain 4 to 5% interest like a savings account. So they'll actually be growing their savings, not only with the use of the reverse mortgage, but being able to put the money in from their regular savings account. And it's insured by the government. It's insured by FHA, and that return is actually guaranteed during the time that they have the reverse mortgage. So it's a great opportunity if seniors are going to help themselves or they're going to help their family to be able to secure some high returns on their savings and also the line of credit growth. That's a huge feature. So if your family or someone you know wants to explore this as an option, feel free to give me a call or give them my number. My cell phone is 305-588-0451. Right now, that product is moving smoother through the underwriting channels than the forward conventional FHA. Even though we're closing those type of loans, also the reverse mortgage is moving a lot smoother because there's less risk to the lender because there's no mortgage payments that are due on a reverse mortgage versus the conventional, the FHA, the VA. So that's what I got for you today. If anyone has any questions, that's my summary of the good, the bad, and the ugly in reverse. Like for you guys to stay safe and stay well. God bless you and your families. And if you have any questions, feel free to call me. 305-588-0451. Thank you and make it a great day.